Hey everyone and welcome. Let's just think of this as our powerhouse study session for your real estate exam. We're going to tear into questions 51 through 75, and I mean really get into them. The goal here isn't just to know the answers, right? It's to actually understand the why behind them. That way, you're going to walk into that exam feeling totally confident.
All right, so we've got a solid game plan. We'll kick things off with the key laws, then jump into hazards and disclosures. After that, we'll dive deep into money and loans, and we'll wrap it all up by crunching some numbers. Sounds good? Let's get started.
First up, the big ones, the key laws of the industry. Look, getting a handle on this stuff isn't just about passing the test. It's about building a real, successful, and ethical career. These are the absolute non-negotiables of our profession.
So let's start with a little scenario. Picture this. On one hand, you have the MLS, a big official body setting commission rates. On the other hand, you've got two brokers just chatting at a party about what they charge. So, what's the common thread here? What legally connects these two very different situations?
And the answer is antitrust laws. Here's the critical takeaway. Any action, whether it's super formal or just a casual chat, that even hints at price fixing is illegal. It kills fair competition. So, it really doesn't matter if it's an official MLS policy or a whispered conversation. It's a serious violation. Period.
Okay, next up is a key term you absolutely have to know: conversion. Trust me, this one pops up on exams all the time.
So what is it? Put simply, conversion is the illegal act of a broker using a client's money as if it were their own. Think of it like this: they're converting the client's funds into their personal funds. It's basically theft, and it's a one-way ticket to losing your license. Fast.
All right, let's talk fair housing. It all boils down to protected classes. You can never discriminate based on race. That's locked down by the Civil Rights Act of 1866. And you can't discriminate based on familial status. So an ad that says no kids allowed, that's a huge violation. But there's one major exception you need to know. Senior communities, those 55 and over places, they are legally allowed to restrict based on age.
And to wrap up this section, let's hit RESPA, the Real Estate Settlement Procedures Act. This law is all about protecting the consumer during the loan process. Now, it specifically applies to residential properties with federally related loans, and its whole goal is to make sure buyers get a crystal clear picture of their closing costs. No surprises.
Okay, let's move on. We're shifting gears now from the big, overarching laws to a very specific agent responsibility. What you need to know and what you need to say about potential hazards.
All right, here's a classic exam question, and it's designed to trip you up. They wanted to know which of these common beliefs about lead-based paint is actually false.
This right here is the big myth. So many people think that if lead paint is found, it absolutely has to be removed before the house can be sold. But that is totally false, and this gets to the heart of the law. The rule is about disclosure, not removal. You have to tell the buyer what you know, give them a pamphlet, and let them get an inspection. You don't have to remove it. And one more key detail, you gotta keep those disclosure records for 3 years. Okay, this is like your quick reference guide for other common hazards. For asbestos, the go-to solution is usually encapsulation, basically sealing it up, not removal. For radon, which is a gas, you need professional testing. And here's the golden rule for you as an agent. You never, ever do these tests yourself. That's a huge liability. Your job is to recommend a professional. That's it. And CERCLA, just remember it's run by the EPA.
All right, let's talk about the money. This next section is all about the financial side of things, the loans, the insurance, and the rules that make it all work. We're going to follow the financial trail.
First up, PMI, or private mortgage insurance. This is a big one. The key question is, who does it protect? And the answer, which you have to remember, is the lender. It's not for the buyer. See, when a buyer puts down less than 20%, the loan is riskier for the bank. So PMI is basically an insurance policy that the borrower pays for to protect the lender in case of default.
Okay, let's play out a real-world scenario. Your client thinks interest rates are probably going to drop over the next few years. So what kind of loan would be a smart option for them?
The smart play here is an adjustable rate mortgage, or an ARM. Because unlike a fixed-rate loan, the interest rate on an ARM can change. So if market rates go down, their payment can go down too. It's all about taking advantage of that potential drop.
You know, a lot of financial laws are about balancing protections. So from the lender's side, they can sometimes charge a prepayment penalty. Why? Because they make money on interest over the long haul.
If you pay the loan off early, they lose out on that future income. But then, on the borrower's side, you've got the Fair Credit Reporting Act. This says that if you're denied credit, you have the right to get a free copy of your credit report to find out why.
Okay, contract for deed. The single most important thing to remember here is when the legal title actually transfers. In a normal sale, the buyer gets the title at closing, right? Not here. With a contract for deed, the seller hangs on to the legal title until the very last payment is made. Think of it as the seller's ultimate insurance policy.
And here we are, the final section, crunching the numbers. Now, don't let the math scare you. This isn't advanced calculus. It's just about knowing the right formulas and taking it one step at a time. So let's break it all down.
All right, here's our first problem. A property manager gets paid 7% of the rent they collect. Now, the potential rent for the building is $8,200, but there is a vacancy, so they're losing out on $820. So how much does the manager actually make?
This is a super simple two-step process. First, you've got to figure out the actual rent collected. So you take the total potential rent, subtract the vacancy, which gives you $7,380. Step 2, just calculate the commission on that amount. 7% of $7,380 is $516.60. See? Straightforward.
Okay, now for the big one, property valuation. I know this can look intimidating, but it's really just a sequence. First, you find your effective gross income. That's just your potential income minus vacancies. Next, you calculate your net operating income, or NOI, by subtracting all your operating expenses. And finally, use the magic formula. Value equals the NOI divided by the capitalization rate. That's the process that turns income into actual property value.
So, we've covered laws, disclosures, financing, and the math. Now, I've got a question for you. After going through all this, which one of those areas felt like your weakest spot? Be honest with yourself. Whatever just popped into your head, that's your next assignment. That's where you need to focus your study time. You've totally got this. Now go hit the books.